pip and a pip value. Pip is a percentage in point, and it is the smallest move that an exchange can make. It falls on a fourth decimal of a price, which is 0.0001 of a dollar. Pip or point is also utilized to calculate the spread. In other words, the difference between the bid, which is how much is someone willing to pay for that instrument, and ask, the price that seller is willing to sell. Spread is also used by a broker as a fee for opening that position on a broker platform. Let me give you an example. Trader opens position buy of a British pound to Australian dollar at price of 1.8450. This means that at the moment when you open a position buy, £1 will give you 1.8450 of Australian dollar. 15 minutes later, price raises to 1.8590. These two decimals at the end mean that the trader has made 40 pips. The value for each pip depends on the size of the position that you opened. Another example, you're selling euro to Japanese yen at price 129.60. This means that at the moment when you open a position, 1 euro will yield you 129.6 of Japanese yen. 15 minutes later, price falls to 127.60. This means you have made 200 pips. Position sizing. Taking into the account that pip is a fourth decimal in the currency price, value per that pip can be calculated using the following formula. Bear with me. You have three types of lots: micro lot, mini lot, and one standard lot. If you look at micro lot, this means that if you open micro, you will be opening 1,000 units of a given instrument. 1,000 units you can replace straight away in your mind, that is $1,000 or a other unit of that particular instrument you are buying or selling. Mini lot, 10,000 units, $10,000. Standard lot, 100,000 units, $100,000. The denomination of this is as follows. Micro lot open position at one micro lot gives you 10 cents per pip. Mini lot, $10,000 position gives you $1 per pip. And subsequently, one standard lot, 100,000 units, which is $100,000, equals to $10 for each pip. When you're looking at this lot sizes, you have to understand that the bigger the lot, the higher return, but also the risk. Leverage. Without the leverage, we wouldn't be here, guys. Leverage is undeniably one of the most significant tools that trader uses to make profits. The most important thing to note is that when you are buying or selling currency on the broker's platform, you do not physically own these assets. Instead, you're entering a position and you are entering subsequently a speculation agreement between you and a broker. You are telling a broker, I am opening the position euro to USD buy. From that moment, I think the price will rise. This is called CFD, contract for difference. Broker tells you, okay, we agree with you. We will allow you to open that position, and if you are right, you will be rewarded. If the open position price changes according to what you've anticipated and analyzed during the technical analysis, considered fundamental analysis, based on that contract for difference, you make a profit depending on how big the move is, and it is calculated in a pip value. However, to make it worthwhile, Forex brokers offer you a leverage. Because of the leverage, you are able to conduct more significant transactions with the smaller capital. Most brokers offer very high leverage of 500 to 1 or even 1,000 to 1. This gives you an unprecedented opportunity to earn off the markets, but please remember that it carries a high risk of losing the capital as well. Hence, the knowledge is the key. The most important thing in this business is knowledge. Understanding risk management, part of the knowledge that is very frequently neglected by traders. If you have a trading account capital of $100, the recommendation for your lot size would be 0.03. What is a 0.03? When we talk about 0.03, that would be a micro lot. You would be getting then 30 cents per point or per pip. Subsequently, when you have $500 or $1,000 per capital, recommended lot will increase because you can take slightly higher risk depending on what capital your account is funded with. Risk to reward ratio is extremely important. When you are putting a stop loss, which is basically a way to preserve your capital and to minimize the risk on a trading, stop loss should never exceed your taking profit level. Your risk should never exceed the reward. In order for a trader to be able to trade a standard lot, which is 100,000 units, you would need a large enough capital, large enough account to withstand a losing trade. Because remember that one standard lot is at value of $10 per 1 point. So if you open a trade that has a 20 pips stop loss and you are stopped out, this means that a losing trade on a standard lot is $200. So you would have to have a certain amount of capital in order to manage risk effectively. And one of the ways that people lose the money is because they don't really pay attention to the proper money management. I cannot stress this enough, and this is the most neglected topic among the fellow traders, where we assume that the things will go your way. But the professional way and the way into the future to move forward is to manage your capital effectively. Money management. Let me give you 5 main reasons for poor money management. First of all, greed. Intention to get fast returns in short period of time. Yes, Forex can give you big returns, but please control your greed. Keep your ego at check. Holding losing position too long due to hope that the price will turn back in your favor is risky. Negligence, not putting a stop loss level or not monitoring a trade, being preoccupied with different things. Lack of consideration, not checking news updates that could cause sudden price spikes. This is a negligence that you are not controlling and you're not looking at fundamental analysis, at the calendar, you're not observing news, you don't know what could be a factor that will trigger an instant spike in a price, in a financial instrument, in your position. And the lack of knowledge, maximizing losses, minimizing wins. All of these reasons can be taught to be controlled. You can learn this, it will take time, but effectively and essentially, you can have a grasp of it. The longer you trade, the more positions you open, the more experienced trader you become emotionally. Thank you very much. Let's go to chapter 3.